Welcome back to Chapter 5. In this video, we are going to be looking at the periodic inventory system and comparing the journal entries with the perpetual inventory system. So let me start with the screen share and get started with my PowerPoint. So the cost flow we're looking at over here is how I record the inventory as it comes in and goes out of the business. As the word suggests over here, I'm going to be doing that periodically in terms of that cost of goods sold account being updated. So I do not keep detailed records of goods on hand. Cost of goods sold is going to be determined by account at the end of the accounting period. So end of the month, end of the quarter, end of the year, just before preparing financial statements. So here's how I would do it. I know what my beginning inventory is because this is what was the ending from last period. So let's say it's $100,000. I will add all the purchases made during the current year, and we're looking at net purchases. That's $800,000 in the example I'm giving you. This gives me $900,000 as goods available for sale. When I do a count at the end of the period, if I find out that I have $125,000 of inventory still on hand, it then means the balance is cost of goods sold, $775,000. This is the 900 minus 125. So unlike the perpetual system where every transaction of purchase or sale, you had that account updated, the cost of goods sold account, in this one, we're going to do it only periodically. So what happens when the transactions actually take place? You record revenues when sales are made, so that stays the same. You do not record cost of merchandise sold on the date of sale. We skip that part. Physical inventory will tell me how much I have on hand, and therefore I find out how much I sold. I'm going to use purchase accounts, purchase return and allowance, purchase discount, and freight costs. All of these are going to be separate accounts I'm going to maintain. So let's take a look at what a schedule would look like. In this example, my beginning inventory is $36,000. My purchases, net purchase is gross purchase, less purchase return, less purchase discount. In this example, it comes up with $307,800. I add all the freight in cost. Freight in is if the buyer pays for the freight charges. When you add that number, that gives you cost of goods purchased. That's a net purchase plus freight charges. Beginning inventory plus purchase cost of goods purchased gives you the cost of goods available for sale. At the end of the year, I calculate what my inventory on hand is. I subtract that number to arrive at the cost of goods sold. And this is the number that's going to be taken into the income statement. So let's do an example and compare the two. So before I work on this, let me do a new screen share. And I'm going to work on the same example that I had in part 1, which I just showed you all the information together. Let's go through it step by step. So on the basis of the sales invoice, we had said that we had purchased, I'm doing the journal entries in the books of the buyer, $3,800 worth of merchandise. In the perpetual inventory system, my journal entry was inventory debit, accounts payable credit, $3,800. I will do either the perpetual inventory system or the periodic, not both. So I have to choose one of these two. So let's say I have chosen to use a periodic system instead of the perpetual. I will do a journal entry on this date. What stays the same is accounts payable credit $3,800. The seller doesn't care what type of accounting methods I'm using over here. They want their money, and I have to record the fact that I owe them that money. I have to debit something. I will not debit inventory because I'm not updating that account all the time. So I use another account called purchase. It's a temporary account. Purchase account, $3,800. Then we said that we received a bill from the freight company, $150, and we paid it. The journal entry over here in the perpetual system was inventory debit, cash credit. Let's say the amount was $150. Now, if I was using the periodic method, what's going to stay the same on this day, the journal entry, is a cash credit. That part's not going to change because that's with an outside party. What is different is the account that I debit. I don't debit inventory. Instead, I debit freight in. Again, that's an expense. Just like purchase, it's a temporary account. The third transaction, the buyer returns $300 worth of merchandise to the seller. So in the books of the buyer, in the perpetual system, the journal entry was accounts payable debit, inventory credit. So basically this first account, we flipped it for $300. Now, in the periodic method, I'm going to debit the same account, that's accounts payable. But the account that I credit, the $300, is not going to be inventory. It's going to be purchase, return, and allowance. I keep that as a separate account, and that is a contra account, which means I will subtract it from purchases to arrive at net purchases. Then we tell that on May 14th, which is the 10th day, the buyer makes the payment to the seller. How much do they owe them? The initial $3,800 accounts payable, less the $300 that we returned, $3,500 is what is owed. So in the perpetual system, our journal entry was accounts payable debit, $3,500 to indicate that account is closed. Cash credit for the amount of check that we wrote. The 2% discount, we credited inventory to indicate my inventory is that much less expensive. Let's take a look at the journal entry in the periodic system. The first part remains the same. Accounts payable debit, $3,500, that stays the same. The second one also stays the same. Cash credit, $3,430, that stays the same. The $70 discount, I don't credit inventory. Instead, I create this new account called purchase discount. This is also a contra account, just like the purchase return. And I'm going to subtract that amount from the purchases to arrive at the net purchase in the end. Now let's look at the books of the seller. They sold $3,800 of inventory to the buyer. Their cost was $2,400. So what was the journal entry in the books of the seller in the perpetual system? Accounts receivable debit, sales credit $3,800. And then immediately they did a second journal entry, cost of goods sold debit, inventory credit for $2,400. And we had noted that their profit on this transaction was $1,400, $3,800 minus $2,400. In the periodic inventory system, we will do only one journal entry, only the first one, it stays the same. We don't do the second journal entry. Again, remember, every time there's a transaction that affects inventory, we're not going to talk about inventory and cost of goods sold in the periodic method. When there is a return of $300 worth of merchandise and the cost of that merchandise was $140, in the books of the seller, we had done two journal entries. The first one was to bring the inventory back in the books, to record the fact that you are going to get that much less money, and second was to bring the inventory back in your books. What happens over here in the periodic method? The first journal entry stays the same, but not the second one. So here also we use sales return and allowance account. It's a contra sales account, contra revenue account. But we don't do the second entry because in the first place we had not done it over here, so there's no adjustments to be made over here. Now let's look at the last transaction we recorded. The buyer pays the seller the money owed within the 10-day time frame. Our journal entry over here was cash debit, sales discount debit, accounts receivable credit. That stays the same here. That's not going to change. Okay, so what we need to note over here is there are fewer entries as you're doing your work, as you're recording your transactions in the periodic system. We use different account names. In the perpetual, everything is run through the inventory account, and you introduce cost of goods sold account anytime you sell inventory, you return inventory, all of those things you're going to have adjustments. But over here, cost of goods sold does not appear anywhere when transactions are happening. It's a entry that is made that appears only in the closing entry at the end of the accounting period, not prior to that. So that we'll take a look at when we do part 3 of the part 3 video for this chapter, when we prepare our financial statements. So once again, this now concludes the second video for chapter 5, and shortly I'll be making the third video for chapter 5.